the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares jumped today on the back of cooling trade tensions between the US and China. So the Straits Times Index was up 0.74% at 3,904 points at about 10:30 a.m. Singapore time, with a value turnover of 883.77 million Sing dollars in the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI closed in the green as well, up a marginal 0.13% at 3,881 points. In terms of value turnover, that's 2.05 billion Sing dollars. Gainers outnumbered losers 371 versus 209. Top advances for today, we've got for you GMX USD, UOB and DBS, and top decliners we've got here ST Engineering, SGX and Singtel. Now in terms of companies to watch, we've got for you Thai Beverage, because the beverage maker announced on Friday that its profit for the second quarter ended March 2025 decreased 3.2% on the year to 6.7 billion baht, or around 263.5 million Sing dollars, and that is from a restated profit of 7 billion baht. Now meanwhile, global market movements remain in focus as investors welcomed the announcement that the US and China would temporarily lower tariffs on each other's products in a 90-day cool-off period. Lots to unpack, and let's break them down with Willie Keng, founder of Dividend.com. Willie, welcome.
Thank you for having me again, Tian Tian.
Great to have you on board. And Willie, let's start with the US this time around. I mean, US markets saw a big rally overnight. S&P 500 index up 3.26%, Nasdaq up 4.35%. That is, of course, as investors cheer that 90-day tariff truce between the US and China. But what do you make of the move, and how long can that relief rally on Wall Street last?
I think it's on everyone's mind right now. I mean, if you look at how Mr. Market, it basically welcomed the news. So everything except the utility sector was actually higher in the S&P 500. You know, you have tech giant like Amazon, Musk, and even FedEx, transport companies whose shares are up, anywhere between 5 to 8%. So that's actually quite a big rally from the previous night's news. So what's to come next is actually pretty hard to say, because in this case, in this whole tariff war, there's really no such thing as a worst case scenario at this point, because anything can happen with a Trump administration. Mm-hmm. So don't forget, even though there's some form of truce between US and China, don't forget there's still a 30% tariff on Chinese imports, which are still remaining in play, which is very close to the original Liberation Day number of about 34%. And also there are also various other tariffs that the US has imposed on steel, aluminium, and automobiles on Chinese and other foreign imports that still remain in place. So while these new US tariffs on Chinese goods, right now they have sort of improved, which is a big improvement. I would say if you look at where the price action is in the market, one thing it's clear here that, the Liberation Day, which was supposed to unwind, since last month, is sort of more or less complete from here going forward.
Okay, and let's talk about Asia, because Wall Street were reacting to the news last night. Asian markets reacted on the news yesterday. They rallied, and investors today, they appeared to remain upbeat as well, though gains were sort of moderating. What stood out to you today in Asia?
I think most Asian stocks, if you see, they have actually extended modest gains, and this really comes on the back on the recent truce between US and China, and also there's hopes that both of the two superpowers will step back from this what they call punishing trade war.
Yeah.
I think what was interesting was actually the call on China. I mean, if you look at how the investment banks today, they are actually making more positive and more optimistic calls. For instance, you have UBS Investment Bank talking about how China's GDP growth is looking to improve between 3.7 to 4%. This was much higher from its previous forecast of about 3.4%. Nomura Investment Bank, they were the first one who called out and raised China stocks to a tactical overweight, and they're also looking to rotate some funds out of India into China. So this is something which is so positive. And at the same time, you also have Citigroup raising its target for the Hang Seng Index by 2% to 25,000 by the end of this year. So I think there are some tailwind for the world's second largest economy, and this really comes on the back from last year's stimulus measures made out by the Chinese government. And at the same time, you also have a potential bottoming out of the real estate sector in China. So I think it sort of bodes well for the tailwind in the Chinese economy. And if you look at how Asian stocks are looking, it seems like there are some more optimistic, more positive movements coming out from the market itself.
You talked about Chinese markets, but just a curious and an impromptu question as well, since we're on the Hang Seng you mentioned. The Hang Seng was the outlier today, I believe, down 1.87% at the close. Any possible explanation for that? I
think it's a very good point you raised out, Tian Tian, because while the street or while analysts have been positive on China, if you look at the Hang Seng Index, they have been down across the board, largely because it was a drag from the tech stocks. So if you look at Alibaba, Tencent, some of the big tech names, even for the electric vehicle makers like BYD, it has been a drag on performance on the Hang Seng Index. I guess it's really because of, number one, the reopening of the economy. But at the same time, you're also looking at some of these tech stocks slowing down, because I guess investors are still pretty uncertain on where the tariffs are really going forward. There are still tariffs in place, especially if you look at some of automobiles companies, semiconductor manufacturing companies. They still do exports from China into the US, and there are still tariffs in place here. So there are still uncertainties here if you're looking at the tech sector.
Okay, and going back to the Singapore stock market as usual, Willie, how did the STI fare today in relation to its regional peers? Any surprises when it comes down to the biggest movers?
If you look at how the Straits Times Index has performed, like what you've mentioned, it has jumped about close to 2% this morning, and I think the market traded slightly lower throughout the rest of the day. Some of the biggest movers, if you look, are the Singapore banks. I mean, if you look at how DBS, UOB, and OCBC, they have opened really strongly throughout the day and sort of maintain that momentum, I guess, largely because of that truce between US and China. And this really bodes well for Singapore banks. Don't forget, Singapore banks, while they do have their dominance in the local Singapore market, but they also have regional exposure. For instance, UOB, they have a sizable loan book within Southeast Asia. You have DBS also attracting a lot of the wealth assets coming from Asia, particularly from Hong Kong, from China as well. So I think this cooling or this temporary relief in tariff sort of underpins some of these Singapore banks' performance. Now, on top of that, I also noticed companies like SET have saw its share price also perform pretty well. I think logistics and transport companies seem to do fairly well, largely because of this temporary relief from the tariff. If you see SET, they have the acquisition of WFS. So in terms of global economic outlook, if you're looking at a more positive sign within the economy, I think this sort of bodes well for SETs. And also, if you look at Mapletree Logistics Trust, where, logistics, e-commerce, the flow of goods across different sectors, that has sort of opened up and have been a tailwind for the logistics REIT itself.
And, Willie, from the logistics sector, let's set our sights on beverage makers, Thai Beverage in particular, because on Friday, Thai Beverage announced that its profit for the second quarter ended March 2025 decreased 3.2% on the year to 6.7 billion baht, or around 263.5 million Sing dollars. How significant is this decrease in profits for the firm, and how far are investors' reactions today justified?
Yeah, I mean, that's a really great point here, Tian Tian. I mean, Thai Bev is something which I've also been looking at, really because it's a consumer play on the economy, and it's one of the very few domestic-driven companies listed in Singapore. And if you look at Thai Bev, what really stands out is revenue has really softened because of the lower sales volume in their spirits business, even though it's a smaller contribution to overall revenue, but it is still an impact. Now, the net profits have also fell on top of the consolidation, largely because of higher raw material costs. If you look at since last year, inflation, while it has cooled down, costs has started to go up as well. And you also have the tariff, which also came into play, from between March and April. So that has some sort of effect on Thai Bev. But if you look from a longer term outlook, Thai Bev is sort of struggling with its operating costs. Over the last couple of years, net profits have sort of declined over the last 3 to 4 years, and it's a result of higher operating costs. And I think this is where, as an investor, we probably will want to take note on how the company is able to control its costs going forward, on top of being able to sell its spirits, sell its non-alcoholic and beer beverages.
And another company to watch, Willie, earlier you mentioned about sets. This is something that's similar as well, SIA Engineering in the same industry, because the main board-listed group reported an 87.3% jump in net profit to 70.8 million Sing dollars for the 6 months ended March 2025. But still, if we go by a boss filing out on Friday, the group's revenue for the second half rose 15.3% to 668.9 million Sing dollars from the year ago period. How would you read into the top and bottom line numbers, and really what do they mean for investors then?
After the COVID pandemic, I think everyone is more optimistic about traveling again. I don't know about you, Tian Tian, but I have been booking flights, and we just both came back on from the Berkshire Hathaway event. So I guess people are more optimistic after the COVID pandemic. And if you see how SIA Engineering is, their travel volume, which they have actually released in their latest results, have actually reached close to its pre-COVID levels, which is a positive point. I think more people are spending more to travel, to go for holiday or for work. And this is really what's driving both its revenues and its profits as well. Now, SIA Engineering, what's interesting is that it is an asset-light business. So whatever it earns on its top line, its revenues, it flows easily down to its net profits. That's why you can see, pretty strong growth on its sales, pretty strong growth on its net profit. What's also interesting is that it has also, tried to recover its dividends, and it is also trying to reward shareholders with its dividends over the last couple of years. And I think this is something which is pretty interesting to watch out for. So in the latest results, management is actually recommending a dividend of 7 cents per share for its financial year 2024 to 2025. So this will be around $78 million being paid to its shareholders. And for its dividends, I think this is something which is worth looking out for investors.
I see. Now, if you're just tuning in, when I'm in conversation with Willie Keng, founder of DividendTitan.com. Well, further away, Willie, gold prices held steady early today as the pause on US-China tariffs lifted risk appetite and lowered the yellow metals appeal. So the movements also come as investors await the latest US CPI report due for the day and implications for the Fed. So 2 parts to this question. First one, what are you expecting when it comes down to the latest CPI numbers and consequently the likely Fed trajectory? And the second part is, what is the outlook ahead for gold in the next couple of months given the on-off nature of Trump's trade policy? Or do you think that as the impact of tariffs start to bite, countries will begin to maybe be more willing to come to the negotiating table and there will be more trade stability, so to speak?
I think it's a very good observation which you have raised there. I think first and foremost for CPI numbers, which is expected to release tonight, I think we all can expect that inflation would probably go up, especially if you look at where the tariffs really started is from early April, where Trump has launched its Liberation Day. So don't forget, while there's still a truce amongst some of its partner countries, there is still the effect of the 10% tariffs across all the different countries. So that's something which investors would be watching closely for, and personally for me also looking closely for its CPI numbers, which is forecast to actually go up, even though the truce has actually come into play. So I think this is something which we also will be looking at. And I think what's also interesting is if you look at the concerns among investors, businesses and consumers, I think people are also generally concerned whether this inflation also would go higher. Now, if you look at gold prices and you see where it is today, it is actually very interesting for investors because on a year-to-date basis, gold prices was up about 25%. And, it has actually been doing pretty well, especially you have large purchases coming from the central banks itself. Gold at one point was about 3,400 per ounce. Now, if you look at where the inflation numbers are, it really depends on how the market is looking at inflationary pressure. Gold typically tends to do well when, there's market uncertainty.
Yes.
So this year, you're looking at the market worrying about a potential looming US recession, trade war, and also heightened inflation. But at the same time, now you have a temporary relief in the tariff, US-China calling for a truce. There is actually a cooling off effect from gold prices itself. So I think it really depends on how the market is seeing this tariff. Going forward, I think where gold prices are, it probably has a softer demand, largely because of the temporary relief. But don't forget, I think market is still uncertain about how the Trump administration would approach the tariff. At the end of the day, President Donald Trump, he is still pretty much very positive on trying to raise tariff across its partner countries. And I think this is not the complete end to the story. And I think that it remains to be seen how things will unfold.
And finally, before we let you go, Willie, let's take a look at corporate earnings. They are due from Alibaba, Walmart, and Applied Materials this week. How would you prioritize what to watch then?
Yeah, I mean, I will follow your order of ranking. I'll look at Alibaba, Walmart, and Applied Materials. Now, Alibaba is really the proxy on how the Chinese economy is faring. It is the country's biggest e-commerce player, and it is also a reflection on how shoppers are in China. And I think I'm closely looking out for its revenues coming from its e-commerce business. For Walmart, also the same thing as well. With the tariff, Walmart basically is a consumer discretionary business, and I think it also reflects how consumer spending behavior is. Applied Materials, I think so far they have beat expectations so far over the last couple of quarters, and I think it also remains to be seen for how the semiconductor business is like. Now, all in all, with the tariff uncertainty, I think a lot of businesses are also trying to pull back on their inventories and expansion. So these three companies, the earnings will be a good time to look at whether management are still positive on the outlook for the rest of the year, whether they still want to expand or whether they're trying to pull back some of their expansion, like what happened during 2021, 2022, where a lot of companies, they started to pull back some of their supplies, and that led to, a huge, surprising, unexpected demand, coming from the market.
Yeah, I see. Lots to watch indeed, as always. Thanks so much for the insights, Willie. That was Willie Keng, founder of DividendTitan.com. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.